Morning, all. Another day, another misadventure. There's so much to talk about. We'll get to Iran later. We've got Bitcoin Tina. Zip it, please. I'm making you co-host.
I just said hi.
Yeah, I know. I don't want you to say anything, please. The floor is mine until otherwise. Um, I don't know where to begin. I need to get my blood pressure down, so I'm going to start with something which is relatively innocuous story. Relatively innocuous, but very important in my view. So one of the things that is making me insane, I'm sure making all of us insane, is in this rent-seeking economy we live in. Every time you put your hand in your pocket, they're coming after you. Everyone's trying to scam somebody or gouge somebody. We all experience this all the time. I don't care if it's, automatic tip being put on your bill, or you want to put a tip. I'm a big tipper, by the way. And the lowest thing they let you do is 22%. Or it's you go for a medical procedure and you get billed some out of network thing, which is like insane. Which, by the way, it's not what I want to talk about. One thing I'll just mention. The other day I went for medication. You're gonna love this one. It's not important what it is. It's a normal. It's a medication you all know. It's one of the popular ones. And I go in, and usually I'm accustomed to paying like $5, $10, whatever it is. And we've all had this happen. They wanted $282. It's like a generic thing. $282. I was like, excuse me? Oh, must be your deductible, the donut, and the insurance, all this stuff. We all have the same nonsense. We know how this works. So I asked someone, like, I pull out of my pocket one of these, I don't know, GoodRx cards or whatever the hell it was. Can I use this? She says, no, I'll do you one better. We have a CVS card I'll use. She puts it in, and instead of $282, it was $28. I'm like, sold to you. I don't care about deductible. All I know is 28 is better than 282. Unlike an X, everyone wants free. They want all my ideas, my research for free. You ain't kidding it. You want the good stuff, you got to buy my Substack. I have a free Substack, but all the cheapskates are just skating on X. I'm done with you guys. I feel used by people who won't pay. It's only fair. So $28 instead of 280. Okay. So I'm out shopping yesterday, and I don't know how you have iPhones or cell phones or whatever. And I hate shopping. So I bought a new iPhone last year. And instead of being a cheapskate, which is usually the way I roll, I just said, do me, just whatever. You want this protection, that protection, this screen protector, whatever. So, instead of the phone being, I don't know, $1,100 or whatever it should have been, it was a 16 or 17. It was 17. I hadn't bought a new phone in like 4 years. It was like $1,400. But I said, you know what? I paid up the extra 300. I'm good. Okay. So we've all had screens crack. So the screen cracks. It's one of these Belkin things. So instead of just going back to the store and, they'll give you a new one and put it on, Belkin has this, not Michael Belkin. Belkin has this thing where to get the free replacement, you have to go online and click some things and send away, and they'll send you the thing, and then you got to take it to the store. I'm like, why are you doing this? We know why they're doing this because they think it's a pain in the ass for people to go online. So I'm like, are you effing kidding me? So anyway, I've had it on my to-do list. I don't know if you guys, everyone has suggestions about good to-do lists. I use the notes on iPhone. It's the simplest thing for me, so I can keep track of what I'm chasing after when I'm not busy going after charlatans on X. So I had this replace a screensaver thing for a couple of weeks. It's starting to bug me. But every time I would go on the Belkin site to click on this and click on that, it always messes up on me. It's like, when you go to put a credit card number in, and the CR code is wrong. So finally I said, screw this. But it was still bugging me. Every time I look at the phone, I got my beautiful 8-month-old puppy dog. She's on my screen. There's all these cracks. So I'm out shopping yesterday. I go into some shopping center I've never been to, and they had one of these. Stores, like we all know them, it's like repair your cell phone type things. So I had one of the Hispanic bro guys in there. I walk in. It's like, you can get a cell phone for like $8 a month or something like that if you want from these places. They're good guys. They're hardworking. They're great guys. So I walk in. I show him my phone. I go, how much? He goes, oh, $15. 1 5. $15. Apple wants 40 for this. And then I said, well, I set up the Belkin store. He goes, look, and he pulls out of the drawer the box of replacement screens he's going to put on. He says, look at this. It's the same as that. It's the same as the Apple store. And he's doing it for $15. Now, it probably cost the company 10 cents to make it. Nobody special can probably tell me about this later. Maybe he pays his supplier $5. I don't know. Everyone's got a markup. Everyone's got their hand in my pocket. $15. 15, not 40. 15. I was like, done. And then we all live in this crazy tipping society. There's a little box. Instead of saying your automatic tip, no, 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 no. There was like one of these little glass jars, tips. I put $3 in there. It's like, dude, you deserve this. $15, 1 minute. I would have tipped him $10. I don't care. So what I'm trying to get to is this. I think a very important story here. This is not about just George going shopping. This is the problem with our economy. It's rent seeking, profit maximization, private equity bullshit, right? And the increasing concentrations of industries, one after another, the Gini coefficient, which is giving companies increasing pricing power. So whether they're in a monopoly or an oligopoly, they all take price. And so people want to know why prices are going up so much. Think about this for a second. And by the way, this is not rehearsed. This is just me winging it. I'm actually acting the way I sound. I'm calm and I'm rational and it's flowing. This is George. Think about your utility bill. Now, I know they don't use oil. Think about, your Uber bill. They do use oil because it goes for cars. Airplanes and jet fuel, those prices haven't gone up so much. That's not the point. But when you think about it and you say, okay, what's one of the biggest cost components of your utility bill or your Uber? I go on a whole bunch of other things. You'd be like, oh, it's oil. Oil's like some parts of the country. I mean, I didn't even hear. I could do the high test thing. It's a ripoff. But, regulars below $3 a gallon. In some places, Jack will tell us about what it's like in suburban Philly. Forget about California. It's self-inflicted, unforced error. Gas is like $2.50 a gallon. Gas in nominal terms is like down over the last 5 years. In real terms, it's collapsed. So explain to me again why Uber has raised prices so much. Explain to me again why utilities have raised prices so much. And Jack's going to get to it in a minute. We're going to talk about, the AI and the capital spending and the green bullshit. All right. This is all self-inflicted. And the people know it. We don't need some idiot like Jerome Powell or Scott Bessent. I got a lot. I got stuff for you this week on Bessent if you want to hear it. You'll have to ask me for it. Explain to you why, it's really not a problem. And while I like him, I say this affectionately, I respect him, but I'm allowed to have violent disagreement with him. I have no time for Michael Green when he gets on and talks about, well, if you take the inflation and you take the last, 3 days, you annualize it, you do the trueflation, you reverse split, turn the chart upside down, and blah, blah, blah. Inflation is only 0.6%, and the Fed's got to cut. Complete, and by the way, I'm not picking on Michael, everyone does it. Completely ignoring the fact, the more important point, that people don't live on rates of change, they live on a level. So that Bitcoin, Tina, if your cost of living went up 30 or 40%, food goes up, rent goes up, all this other stuff. And you may have gotten a 5 or 10% pay increase for 2 or 3 years, but the fact of the matter is, in real purchasing power terms, you've lost money. People live on a level. They don't live on rates of change. And before anyone, and Michael Green, if you're listening to this, I love you, man, but please do not try that condescending IQ contest. I'm the smartest guy in the room. And please stop it with a passive bid. I love you, man. You've done some great work, but that work is useless. I hope someone tapes this and gives it to Michael. That work is useless when it comes to adding value in the market. When was the last time you had an equity recommendation that actually made anyone any money? Never. And, so I love you, man. So I say this respectfully, but friends are allowed to respectfully disagree. And I know you're a gentleman. You were totally wrong on bonds then. You're totally wrong on bonds now. People are running these narratives, these stories. It's just, we all know it's wrong. We all want the truth. It's a lot more I could say, but that's my introductory monologue. Mr. Nobody Special, how are you, my friend?
I'm doing good, George. How you doing this morning?
Excellent. You and I talked a little bit ahead of time. We're not going to talk about Iran right now. We're talking about it later. One of the reasons I don't want to talk about Iran is because, well, it's a polarized issue for a lot of people. But more importantly, I think this is often the case. The first reaction is going to be the wrong reaction. I actually think this is an incredible time in history we're living through. Um, I think if this plays out the way I hope it plays out, and actually the way I believe it's going to play out, the world is a far better place than it was 48 hours ago. And love him or hate him, and I hate him. Donald Trump has done a huge favor for the world. Bibi Netanyahu, I'm deliberately going to say this, going to trigger people. I don't care. We can discuss facts. But if people want to say he's a hater, he's a boomer, I'm going to block you. Another thing, someone put something on this morning. I just love these folks. I'm sorry, Jack. I don't know for another minute here. So, I got in a lot of dust ups this past week. And I'm going to read something to you later. My good friend Tom Thornton had said, George, you're better than this. Don't do it. So I'm not going to do it anymore. And I promised I wouldn't do it. And I never draw first blood, but FAFO. Just because I'm 69 doesn't mean I don't have a bite. And my four-letter vocabulary is much better than your four-letter vocabulary because I've been at this for 69 years, and the average idiot millennial has been at it for 26 years. So someone comes after me this morning. Oh, it's terrible. George blocks anyone who disagree with him. Sad. You know what? Fuck you. Fuck you. No. Look more carefully. George blocks anyone who throws ad hominem attacks, who insults and doesn't stick to facts. And usually that's the purview of the MO for people who don't have the facts on their side. They don't have the facts on their side, so they deflect. So I posted, I only block people when they leave with ad hominem. I used to put that in my bio at the top of X, but I'm not sure it's there anymore. I think any responsible person would be like, yeah, let's have a conversation. Let's engage in the Socratic method. God gave you one mouth and two ears. Let's learn from each other. Bitcoin Tina and I, way back, we're good friends, know each other forever. We used to have some pretty high pitch level. It doesn't matter. It's all good. We learn from each other. And so, I say something. He's not going to say, George, you're an idiot. He's going to say, I may disagree with that, but yeah, it's interesting. And in turn, but George, this is what I think about what you said, which I resonates with me. I hadn't thought about that, but here's the part of the thing. I disagree with you. Not, and it was one the other day, a very good friend of mine. You're going to laugh. I'm not going to mention names. We were talking about something. I don't remember what it was. Not important, the subject matter. And we've been known to disagree at times, which we should be, because if we're reinforcing each other, it doesn't do anybody any good. And instead of just saying, gee, George, I have a different point of view, he said, wrong. I was like, wrong? Excuse me? Wrong according to whom? Could be right, it could be wrong. But is that the way to win friends and influence people? And so this clown on X this morning, and by the way, I called him right away, and he goes, "You're right. I come on too strong. Mr. X, come on too strong at times. I shouldn't have said that." This clown this morning says George blocks everybody. No, George doesn't block everybody. George blocks people who resort to profanity, vulgarity, and throw shade. And it's clear they're haters. If Thornton comes in this room, I might get in trouble. I promised I wouldn't post any negative shit about people anymore. Let's see how long I can do this. It's going to be hard. It's like kicking alcohol or smoking. It's who I am. And Tina, you know that. Thornton was like, I'll believe it when I see him. But, you take someone like Larry Lepard, who's a smart guy. He's a nice guy. He's a good guy. I'm going to try to take the high road. But he is so butthurt over his Bitcoin. He can disagree with me. That's fine. I'll be right. He'll be right. Sometimes he's wrong. Sometimes I'm wrong. But who is he to talk to me this way? He went to Harvard? Oh, okay. I'm impressed. I went to Yale. I went to Wharton. I used to manage the number one mutual fund in the country. My dick is bigger than yours. You want to play dick size game? We can play that game. I know he's going to win that one. It's not the way I roll. But he comes at me with a profanity and the hate, telling me I'm a moron. And should I read his book? And then conveniently ignores the fact the first time we met in the summer of 21, it was at a Blockworks conference at Mount Washington up in New Hampshire, Mount Washington Hotel. And I was there with Greg Foss. These guys are going on about Bitcoin. And, I was right on Bitcoin before I was wrong. I freely admit that I was wrong. What the fuck? Who cares? They're as human. But see, Larry Lepard can never admit he's wrong. Because he's a hot-headed fellow who talk about identity politics. He's so closely identified with Bitcoin. You say anything negative about Bitcoin, it's about him. And by the way I know you're right, and I don't really care what Larry thinks. I'm talking to the thousands of people on X. The way you know that he's full of shit, and I am saying he's full of, or let me scratch that. The way you know he's totally wrong is because if he had a better response, a substantive response, he'd go with it. The fact that he gets so emotionally triggered, I don't care what it is. You could talk about General Motors or Ethereum or Oklo or Nvidia. If you get triggered, I'm teasing you now, Bitcoin Tina. If you get triggered talking about any one of these things, and you launch into a Bitcoin Tina imitation on a bad day or a George Holm imitation on a good day, that tells you that you got a problem. And the problem isn't that George was wrong or Bitcoin Tina was wrong. The problem is you are so over your skis, so far down the rabbit hole on your idea, you cannot tolerate another point of view. Reminds me of William F. Buckley Jr. Liberals are all for hearing other points of view until they find out there is another point of view. We have diversity of religion, diversity of skin color. How about diversity of thought? Does everyone have to be a Bitcoin bull? Can't we have a good discussion? You're bullish, I'm bearish, and maybe we learn from each other? It's like you look at the Democratic Party now. Does everyone have to be pro-choice to be the Democratic Party? I happen to be pro-choice, just to be clear. But there used to be a time, once upon a time, when it was a big tent and all points of view were tolerated. Now you have to be anti-Israel. You have to be pro-choice. You have to be open borders. You have to be for trans bathrooms. If you're not for all these things, you're not welcome to the Democratic Party. I can say the same thing about the Republicans. Unless you're after support every fakakta, fucked up, grifting idea that Trump has with the coins and the Lutnick and the this and the that. Unless you kiss the ring and you're hardcore MAGA, you're not welcome. Fuck you. Fuck you. And by the way, I'm not going to edit this at all. I'm good with this. And that's Larry Lepard. Larry wasn't raised this way. It's not who he is. But we spoke in another space the other day about if you get to a point where the position owns you instead of you owning the position, you're in trouble. That's what got me in trouble in 23 with my disaster CTF. It started out with a good idea. Was bearish in 21, later at the end of 21. Became the Pied Piper of spaces. I had the bearish playbook in 22. You guys all remember the good old days. We'd have like 10, 20, 30, 50,000 people in a room. The ETF started late. a month was in the low. Told everyone it was going to be short. They assumed it was going to be short. Timing was off. I got caught. And then I was faced with the dilemma, what do I do? It was wrong. I was wrong. Larry Lepard, you're wrong sometimes. I used to be friends with Larry Lepard. I even posted an email exchange the other day. And this is all about him. This is not about me. I should read his book. And maybe that'll make me unstupid. Larry, what has gotten into you? And by the way, the really rich, funny thing is, I didn't finish the story about summer of 21. So I meet Larry with Greg Foss. Oh, I didn't know Greg. Greg was one of the Bitcoin evangelists. So I'm at this Blockworks conference. Bitcoin is 35,000. This is August of 21. Listen, boys and girls, August of 21. They were so sure of themselves. The hubris is dripping with hubris. So sure of themselves. And I learned how insulting it is. I was guilty of being a boomer. I was a boomer. Accused of being a boomer. I had no comeback. They're boomers too, but I digress. Excuse me. So Greg Foss has the cojones. This shows you the sentiment. He bet me, this is August of 21, that Bitcoin was going to be $100,000. $100,000 by December 31st of that year. It's like 5 months. I'm like, okay. Steak dinner. And by the way, someone reminded me the other day when we had this back and forth spat with Larry, is American Hodl, Bitcoin, you probably know where he lives. You should reach out to him. He also owes me a steak dinner. So American Hodl was the one who I first made the bet with. And he tried to pay me a couple of years ago, but I didn't have a Bitcoin account, so I couldn't take the money. Maybe I should open one. At any rate, but American Hodl's cool. He disagrees with, yeah, George, smart guy, wins some, lose some, whatever. Not Larry Lepard. Not Larry Lepard. And so I'm at this conference, and Foss is there, and Larry's standing there. We'd spoken on the phone, I think, a couple times previously, but we never met. First time I met Larry, it was fine. We're both from Boston. We know a lot of the same people. And he's like, I went on this bet too. So I bet each of them a steak dinner. And it wasn't like over under, like it's up or down. It was like Bitcoin has to go to $100,000 by the end of the year. Keep in mind, it's 35,000 we're having this conversation. There isn't a single person in this room. I don't care how much you're a fully paid up Bitcoin acolyte. There isn't a single rational person in this room that knows how to use a calculator that can calculate them. You don't even have to know what the implied volatility is that would make that bet. Unlike it's like taking candy from a baby. All right, so roll forward. We get to D31. It wasn't grave dancing. I was like, Greg, yo, what's the deal? He goes, George, should I send you the money? What do we do? We even had a back and forth. You know what? Let's have a dinner in Boston. It'll be Lepard, Greg Foss, and me, and we'll turn it into a charity dinner. I'll get like 20 other guys to show up. They can each kick in $1,000. We can make 20,000 bucks for charity. It'd be fun. And if you look at my Twitter feed, you'll see there's the email traffic there. So as recently as January of 22, Larry and I were good. And then what happened a few months later, I have to go back and look at, but the way it went basically was there was discussion about Bitcoin. It was going up, it was going down, whatever it was doing. You're not trying to be respectful. And he was so butthurt. He was having a bad hair day or a bad hair month because Bitcoin was in a drawdown. He went nuts on me. The ad hominem, the nastiness, you're stupid, you're this, you're that. I'm like, where did that come from? And he's never forgiven me for that or forgiven himself. Then he trash talks me to another guy like Chris Irons. Everyone knows Chris. I should talk to him. Chris is a good guy. QTR, quote the Raven. I'm a subscriber. I pay his shit. But he's tight with Larry. So of course, Larry bad mouths me to Ravens, right? And it's just like really, like you're like children. In any event, maybe someday I can become friends with Larry again. Not that I need him as a friend, but smart guy. I like talking to smart guys, especially smart guys I disagree with. But he's done this all to himself. And the hilarious thing is, he's got thousands of maxis who fall in line with him, and they're all pile on. But in the end, doesn't matter what I think. Doesn't matter what Larry thinks. There's a right way to do things and a wrong way to do things. And your mother taught you how to behave yourself. Larry's behaving very badly. And the most important thing is, what is Mr. Market going to say? I commit to you, as I always do, I will accept the judgment of Mr. Market. People go, this is not going to age well. I'm going to put a timer on this. You know the nonsense, right? So you know what, Larry? Let's check back a year from now, 2 years from now, 3 years from now. I don't care about 1 week, 2 weeks, 3 weeks. And hey, if you were right, I'll tip my hat to you. And if I were right and you see the error of your ways, maybe you'll have decency to tip your hat to me. But Larry, there's no excuse for the way you behave yourself. None. None. And by continuing to act like a jackass, you're just making it worse. Keep digging. And I'll stop because I really want you to talk, Jack. This has been one of my more, I don't know, there's just so much to talk about, one of my animated frames of mind. What this app does to people, at least Larry, we know who he is, everyone knows who I am, but especially the folks who come on with an alias, they speak in ways they would never speak in person. And so you got Larry, who's a big, public person, who's been very successful. And I'm not going to play gotcha with Larry because I don't believe in gotcha. People play gotcha with me. My ETF was a disaster. By the way, if there's any, you know what, boys and girls, I may change the title of the space today. I'll take all calls, AMA, about the Nope ETF. I don't care. I own it. I fucked up. So what are you going to say? You think my feelings get hurt when people say, oh, well, what about Nope? I don't care. I suppose every trade that you've done in your life has been right. You've made money on it. So anyone who stoops to the level of gotcha, like that's stupidity. Let's just talk about it, like right here, right now. Like Jack, you're going to talk about data centers in a second. I see Grant, you're putting up the 100%. So Grant, let's talk about the real estate deal you fucked up 9 years ago in Dallas. Remember that one? Forget about the fact you had an entire career of nothing but success. But the idiotic haters are going to cite that one Dallas real estate project you fucked up. I mean, it says more about them than it does about you. But that's the way so many people on this app roll. They're never wrong. They're haters. They're jealous. I remind everyone, if you have nothing good to say, it's what your mother taught. Nothing good to say, don't say it. Truer words were never spoken. All right, Jack, I now need to rest and take a glass of water. The floor is with you, all yours. You know the drill. Go. We spoke about, I was in your space on Friday. I urge everyone, by the way, and I'm not getting paid, to follow Jack on YouTube. If you pay up for he charges such a little amount for his thing. If you pay up, you can be part of his thing on Friday afternoons, where he's got a little like chat thing going. And the reason I sound so brilliant when I come in on the weekends is because I just steal and plagiarize, stroke borrow what he says on Friday. So Jack, the floor is yours. How about it?
That's a hell of a setup, George. Thank you. All right. Let's go right into what's in the title here, AI No Mas. So a lot happened this week, and there's a lot we could say about it. I'm just going to start with Wednesday and NVIDIA earnings. When we ended this space last weekend, George, I kind of like dropped on the last word. I said NVIDIA earnings on Wednesday this week, they're going to be excellent, and chances are the market won't care. And that's when you pretty much nailed me down and made me commit to doing this space. Well, we went exactly that. NVIDIA's quarter was, for all intents and purposes, magnificent. It was a perfect quarter, and nobody cared. And that's the takeaway there, that nobody cared. So if
So
you
so
look,
so wait, just now I get this straight. Nobody special is saying that nobody cared. Got it. Okay. I don't want to
yeah,
make sure I got that clear. Go on.
lowercase, nobody cared.
Got it. Go on. Go on.
I'm not speaking in the first person there. Uh, so what's going on? You've got people posting all over the place that NVIDIA looks cheap here. Oh, they're talking about the PE. Well, there's a reason why NVIDIA is starting to look cheap. Is the market knows that this bubble's days are numbered. They know that this data center build out is not sustainable for any number of reasons we're going to probably get into on this space. And therefore that these earnings are not going to stay magnificent. And so nobody is going to pay up for tomorrow's earnings. That is what the market told us with NVIDIA. And there's one very key data point in NVIDIA's earnings and their revenue. And look, 1 point, I forget what the actual numbers. I don't have the revenue numbers here, but high double-digit growth consistently, but 91% of their revenue is coming from data centers. All right. All their eggs are in that data center basket. That is a lot of eggs in one basket. And the market is saying we don't believe it. And what is NVIDIA without its data center revenue? It's a gaming company that has pissed off every gamer in the world. And so, the market's saying we're almost out of time here. And we saw the same thing when big tech reported their earnings, which were all pretty good. They all increased their capex, and for every dollar in capex, they lost $2 in market cap because the market is saying no more. Stop burning our money. So that's the takeaway from NVIDIA. Initially, you had a bunch of people bid up the stock. They lost money. You had all the people that bought options. They donated premium to the market makers. And here we are. NVIDIA has gone a whole bunch of nowhere since August of last year. 3 quarters in a row of beat and raise, and nobody cared. Classic bear market signal, in my opinion. Then we had some more data center numbers the following day. We had 2 very divergent earnings reports from CoreWeave and from Dell. And CoreWeave is just my favorite topic in the whole wide world to talk about. CNBC, with their magnificent bit of sell-side quackery, came out after their earnings. NVIDIA, CoreWeave, big revenue beat, backlog surges. And since when do we even care about backlog? Why do we care about spending commitments from companies that don't have money? I don't know, but that's what CNBC leads with. Nice quarter from CoreWeave if all we're talking about is revenue, right? 1.57 billion in revenue. That beat expectations. But here's the problem. $452 million lost. Quarter over quarter, CoreWeave's losses more than quadrupled. They were 110 million in the September quarter, 452 million. All right. So yeah, we lose money on every transaction, but we make up for it in volume. That is what CoreWeave told us. This company's not profitable, never been profitable. They're getting less profitable, and they have no conceivable path to profitability. I've been saying this since 2023. CoreWeave is nothing more than a special purpose vehicle, an off-balance sheet arrangement to inflate NVIDIA's revenues, that it was created by financial degenerates of the highest orders. I'm talking guys who ran a pump and dump scheme called Cicerex when they got out of the Ethereum mining business that dropped 99% as soon as they completed their reverse triangular merger. Complex financial arrangements is the hallmark of these guys. These guys used to run carbon credits through shell companies in the Cayman Islands in the earlier 2000s when they were pushing cap and trade during the Obama years. And now they're a data center company. And of course, they got together with GFC, Uber scumbag Magnetar Capital. That's where all their money came from in the original. And I warned about this years ago, and everybody told me I was a paranoid conspiracy theorist. Call me old-fashioned. I think reputation should matter for something. Their debt jumped by $4 billion. And that's on top of the $2 billion they got from NVIDIA buying their stock. Revenue jumps by 200 million quarter over quarter. That's not bad, but their accounts receivable jumped by 1.9 billion. Oops. I don't know how you channel stuff a data center service, but they figured it out. 1.9 billion jump in accounts receivable. They're not getting paid. Where did all that money go? It went to Dell. Dell's quarter was fantastic. They guided for 103% revenue growth in 2027. Server business is booming. 20% increase in their dividend, an additional 10% or 10 billion in buybacks. It turns out when your customer, CoreWeave, doesn't care how much money they lose, that's really good for your business. Hence, Dell's earnings were fantastic. So that was the data center and the AI earnings snapshot of what happened this week.
So, Jack, if we stand back and people can look, you and I talked about this earlier. You can look at CoreWeave's numbers. You can look at NVIDIA's numbers. You can look at spending plans from this guy or that guy. You can look at Blue Owl blowing up. You can look at protests against rising electricity rates in various places because of data centers. You can look at any one of the things by themselves, but they don't exist in a vacuum. They're all related. And so I was joking with you, or actually seriously discussing with you earlier. The semi stocks. Who knows? We all know the reasons why this cycle's, gone so much higher and further than anyone thought. But good things come to an end at some point. I think you and I both believe that these stocks will be epic disasters, whether it's an '06 or a 26 or 27 event. I don't know. I have no position. But history usually doesn't work out too well buying semi stocks and 7 times book. So when you stand back, Jack, and you look at the plane, like you're up in the press box, right? So you're not on the field. We're missing as a receiver downfield. You're up in the press box. You got the binoculars. You can see the whole thing playing out. They got to keep the plate spinning. And it seems to me that this has become a matter of existential matter. At least the U.S. government's made it an existential matter, even though I don't think it should be, because they've been captured by tech bro, Silicon Valley bro. Those guys keep writing the checks. Trump keeps taking the money. It's like there's nobody up in the box, or a better analogy might be air traffic controller. You see all these planes flying around, right? But something's gonna. You need to have an air traffic controller to make sure that if there's a plane that's got to land, you let them down. And what bothers me, Jack, is that like all this stuff, seemingly disparate stuff, is happening, but like there's no conductor that's making sure the music keeps playing, and therefore the chances that one of these things is going to break and what that does to the whole daisy chain is pretty darn high. So, what part of that agree with, disagree with? What part of that triggers you? Any thoughts, comments, reactions?
I agree that the first sign of weakness, either one of the big AI companies scaling back their plans, a la Anthropic, OpenAI, or XAI, or one of the hyperscalers cutting back their capex. That's ultimately going to be the big trigger that starts the big sell off. When is that? Again, if I had that in my crystal ball, I'd be a much richer man than I am. But I hear so much about how compute constrained they are. Right, the sell side guys always love to talk about how they're compute constrained. We don't have enough compute. All right, well, I have other constraints in mind. I look at them and I say they're cash constrained. Where is the money going to come from to buy this compute? All of their customers that they're renting these GPUs to lose money. They need an endless supply of investment capital. They can get it from private credit. Good luck with that. Things are going really well in private credit right now. They can get it from the government. They tried that last fall when Sarah Fryer went on and asked the government to backstop their debt, and it was the market response from that was hilarious. Sam Altman went to the Middle East trying to get money from the oil sheiks. He came back empty-handed. Still nobody in the press admitting that happened. Hyperscaler free cash flow has now been exhausted, and the numbers need to keep getting bigger just to stay where we're at. The numbers need to keep getting bigger, and NVIDIA earnings told us that. So where are they going to get the money from? They're also laws of physics constrained. The power grid and the enormous duration mismatch between how soon the new demand for power is going to get here versus how soon the new supply is going to get here. I mean, these guys are daisy chaining decommissioned jet engines together to try to burn enough gas to get these data center builds. They're buying Generac generators. They're buying Caterpillar diesel generators, anything that they can to turn a turbine to generate some electricity. They're also politically constrained, and I think this is something that you really need to watch out for in the coming days. Affordability. I mean, your whole tirade at the beginning, George, about affordability. Imagine what that rant sounds like for the average person, on Chestnut Street or wherever. And now we're being told we're using your 401k to drive your electric bill higher to put you out of work. Isn't it great? And we want to build this right next to your house.
Wait, stop, stop, stop. That may be one of the best ones ever. I want you to say that again. We're using your 401k. Say it again.
And we're using your 401k to drive up your electric bill to put you out of work. And I can't even remember what oh yeah, we want to build it right in your backyard.
You're hurting me, Jack. I love you, man. Keep going.
And the point I'm making here is you now have almost universal political opposition to data center build out. It's happening quietly. It's not getting a lot of coverage, certainly not in the financial press because they're sell side analysts mostly. In just the last 2 weeks, I saw a story in San Marcos, Texas, which is a college town surrounded by farms, kind of a purple area. They got a data center canceled there. We had a data center was canceled in New Brunswick, New Jersey, which is right where Rutgers University is. That's bluer than blue. They got a data center canceled. You got farmers who are up in arms in Mercer County, Kentucky, redder than red, opposed to data centers. Politics, especially midterm politics, by October will be a contest to see who can be more opposed to new data center buildouts between Republicans and Democrats. Data center will be a 4-letter word by October this year. And how do you continue these growth numbers in that environment? You just can't do it. I'm just going to go. I think George is looking for his mute button.
I found it. Jack, when I'm quiet, something's got to be wrong. Like I'm on mute because it's just not the way I roll. We love each other, man. We're good. You're right. I was on mute. It's the only possible way I could be quiet. So Jack, so we always try to help the folks. We could be wrong, but from where you sit, a reminder of the line, only ask questions, the answer to. So for investors, in terms of what they do, the prescriptive part of what you are saying, whether it's avoiding Mag 7 or switching from S&P to equal weight S&P or shorting the neo clouds, again, I'm going to channel my inner nobody special. We works with GPUs. So it's one of these speech and a question type deals. What should investors be doing or not doing in view of what you're saying?
So I'm just going to go with what I do with my money. I always throw the asterisk. I don't have the permission slip to tell people what to do with theirs. All right. So you're right. I'm avoiding Mag 7 like the plague. I haven't done this yet, but I'm considering consumer staples. I think it's probably still a little early. I think when the consumer staples goes along with everything else. I like defense names here, especially with recent headlines. A comfortable cash position with a shopping list ready, and gold and silver in particular. By the way, silver had a fantastic looking chart this week, and you had another very suspiciously timed technical glitch at the COMEX right as silver was about to break out from the previous high from that dead cat bounce on February 4th. Gold had already taken out its February 4th high. Silver broke out from that short, a day after the data center glitch, if you will, retested that level, moved higher. I think oil and precious metals will tell us a lot this afternoon this evening when trading starts. Right now, you got a lot of fog of war. You got a lot of, pardon my French, but a lot of bullshit flying around on social media. That's all just basically prescribed pre-existing political dispositions. Oil and gold will tell us what's going on in the Middle East tonight.
So, Jack, a statement and a question. So, one of the reasons I didn't want to lead with Iran, I did say along the way, the first reaction is usually the wrong reaction. In this particular matter, I'm actually going to be the optimist. I think this is going to resolve itself relatively quickly. Tina, I'm going to invite you to get back up here. You left. You abandoned me. I'm going to get you to be co-host again. I see they got oil's up 8-10%, whatever it is, and precious metals flying. So, trying to predict short-term gyrations is particularly dangerous. But if I had to put a gun in my head, I probably would fade the move in oil. Even though I like energy stocks, I'd fade the move in oil because I think this is going to get resolved favorably. It's my hope. It's also my belief. Anyone who cares about the world should hope this gets resolved favorably. So I'd fade the price of the movement in oil. Jack. We got Tech Bro, we got AI Bro. Remember the Shipping Bro? So Shipping Bro is making a comeback this weekend. They're back. They got they got the maps up and the Straits of Hormuz thing going again. You know what I'm talking about? And so Shipping Bro are at it again. All right. So if I look at the Twitter sphere and what all the chattering heads are talking about, And if I see, wait for it, 3, 2, 1. How long is it before Kobayashi letter comes out with another graph of VLCC rates or whatever? So that's all in play right now. So I would probably fade oil. It may go a little bit, but I think oil's lower a month from now. And precious metals, Jack, I think they're going to sell off. They might, but neither you nor I owe them because the Straits are moves or around. So I actually kind of hope gold and silver go down because they're going much higher. I know you believe that as well. So Jack, here's the question. I want you to talk about NBIS because you know this, Jack. Sometimes you look around on Twitter and you look and you want to see where the Twitter gangbang is taking place. Probably shouldn't have used that phrase because it's too graphic, but where's the crowd? So I like to look for the crowd. And the crowd, when you're like, oh, that's not normal. So one of the not normal ones is NBIS. They have cousins. They got Irene, IREN. They got Cipher. They got a whole bunch of things. So it's kind of unusual to see, a mid cap, small cap stock with such sponsorship, and it's like ubiquitous. It's unbelievable. So not to be a wise guy, but I'm gonna tee it up for you. It's like T-ball time. So to me, the valuation makes no sense. Um, it's not clear to me if this company's going to make any money ever. And people say, well, it's got a market cap of a few billion, but it's got a backlog of umpteen billion, blah, 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 blah. How could you not own it? Well, the reason I don't own it is I just spent 30 seconds with a piece of paper. And, as I say, math is hard. Math is hard. Liars figure, but figures don't lie. Like, I really don't want to hear the story when I just look at the numbers. But so you have something which makes no sense on the paper. The people recommending it for the most part, there's an inverse correlation between financial illiteracy and enthusiasm for NBIS. Stock's up huge the last few years. You have such leading luminaries, financial luminaries as Eric Jackson pumping the thing, and others. I think it may be in the Dan Ives 30 or whatever. So you got all the wrong people involved in the name, right? So I go check, 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 right? Like it's a short. Okay, so I teed it up for you, Jack. Give me your stream of consciousness on NBIS.
All right, George. So Nebius, let's say hypothetically, because I hate the whole neo cloud space, and I've said this before a lot of times. It's we work with GPUs. I think it is a flawed business model. None of them make money. I don't like this space at all. However, let's say some bad actors were to break in my house, kick in my door right now, duct tape me to a chair, pry my eyelids open, and make me watch the new Star Trek series until I caved in and acquiesced, and they forced me to buy a neo cloud company. After about 5 minutes, I'd probably give in. Um, Nebius would be the one that I would buy. I would not touch the space with a 10-foot pole, but if I had to buy one, it would be Nebius because all the problems of CoreWeave, yes, but they have much smaller debt load. They're not nearly as levered up as CoreWeave is, and they also use a more honest depreciation cycle. Nebius uses a straight line 4-year depreciation cycle for their GPUs versus CoreWeave straight line 6, which is what most of the hyperscalers are using. So I hate the space, but if I had to, if we're playing a game of Would You Rather, it would be Nebius.
Okay, now Jack, more broadly, let's step back. Whether it's CoreWeave or it's Nebius or any of the other ones, why do you hate this space?
I hate the space because I like to make money, George, and this space does not make money. This
Well,
space
okay. So, all right, I'll put it another way. What are the bulls getting wrong about these stocks?
It's really simple. They don't make money and they never will. That's what they're wrong about. They never will make money.
Right.
These GPUs will be depreciated to nothing before they even cover the debt they took out to buy them. This
Right.
business model was dead from day one. It was never a business model. The whole neo cloud space has been just to inflate the revenue numbers to keep the bubble going.
By the way, on a serious note, uh, Jack, when you come up for air for a second and you're not talking, could you call or text Coleman, see if you can get his ass in here so we can get an update from him? And on a less serious note, if anyone knows Eric Jackson or any of the defenders of NBIS or any of the neoclouds, they're welcome to come in here and explain themselves. Um, all right. So, Jack, why don't you rest for a second? Maybe see if you can get Coleman to come over here. I want to turn to my good friend Thomas. I don't know if he's listening or he's making his breakfast, but
Nah, I'm
Thomas,
here, George.
Thomas, good to see you. What's on your mind, my friend?
So I jumped up here just because I reacted to the title you have here in the spaces, and so I want to ask a question. Um, I would say this: I agree wholeheartedly that the amount of malinvestment in the aggregate in the AI space is uh, a train wreck ready to happen. At the same time, I'm very bullish on the concept of AI. So they're two different things, and I go back to the 1990s, the late 90s, on the internet boom, the dot-com bubble, where everything prior to March 2020 to the left of that in the time series was prolific malinvestment and overvaluations of even big companies like Cisco. And that once we cleared that malinvestment, we had sort of an economy transforming technology through the internet, and there were other winners. So at, at this phase, to me, it feels like it's easier to pick losers than it is to pick winners. I can't. I don't know how these companies that are spending hundreds of billions of dollars are ever going to return on that capital.
100%. Nobody care to weigh in?
Yeah, I agree with that sentiment. AI is not going away. The technology is here. I do think the current cast of characters, the hardware players, it's a space that's becoming heavily commoditized, which means these margins are going to evaporate. Those that even have margins to begin with, most of them don't. And I would defer to guys like Ilya Sutskever, guys like Gary Marcus, who have come out and said, like, the large language model is a failed experiment. We're not going to achieve AGI with brute force compute. And so we've probably peaked for the next couple of years as far as how good it's gotten. It's not going to be smarter than people next year, like these desperate people are claiming with increasing frequency. I think we've plateaued as far as advancement goes. The bubble will burst. Many will go under. If you're able to pick the winners, God bless you, because if you could pick the winners of the .com crash, you made a fortune. But I don't have a lot of confidence in my ability to do that, so I'm avoiding the space
Yeah.
entirely.
Yeah, just to fill in the blank, Thomas, I know you implied this, but just to be more explicit, you know, you're totally right. Up until March 2000, those stocks did incredibly well. And then it was an epic wipeout. Amazon went from 100 down to 9. And that's whatever it is, 2000 split adjusted, whatever. Point was, for the next 10 years, the capital destruction was extraordinary. And I did interview hasn't come out yet, but Peter Bears, a bank credit analyst, really smart guy. I interviewed him last week. I think we're going to post it today. And he's also negative. And he had this amazing statistic. And Jack, you probably know this one. You'll correct me here. I don't remember exactly, but the gist of it was, I think data or internet usage or whatever since 2000 has compounded, I think, at 43% a year, some number like that. So it's gone up by 25 million% or whatever 43% is for 25 years. It's gone up by that much. But that didn't mean owning those stocks was a good idea. In fact, he got destroyed. Yeah, now eventually it worked. The survivors worked, but Amazon went down 90 before it became a good stock. And so for the financial illiterati who don't know how to use a calculator and don't understand valuation, and they're just chasing narrative and charts, they're in for a rude awakening, in my humble opinion. I think we agree on that. Um,
Yeah, so I got in the AI industry in 2013, uh, and we immediately saw the promise of where this was going, and the issue was scalability. How fast could you scale it? And we ran into all kind of technical walls, and the LLM architect, the GPT in 22 that came out, that was a tremendous breakthrough. But I would just say people should not expect LLMs to be AGI and super AGI. It's a component of an architecture, but the next set of art, we need a breakthrough architecturally that sits where LLMs is a component, and that's still emerging right now. So LLM is going to take us to a certain point, but it will peter out if that's all it is, right? Because it's just pattern recognition on large corpus of data. You need architectural evolutions where you have world models, recursive self-improvement, agentic structures, and those are still working themselves out. And and I just think if we get to that point, that nirvana of AGI, what everyone's kind of searching for with all this malinvestment, the malinvestment is going to LLMs, which is not where the future is going to be AI wise. You certainly got to get it right, but that's going to get commoditized, and you're going to move to new architectures and new investments, and it might take 2 years, it might take 5 years, it might take 10 years. I don't know, uh, but I'm bullish on AI, but bearish on these malinvestments. That would be what I would say.
So, Thomas, extremely well said. Um, this reminds me of you know, there's a lot of examples I could push back on you or agree with you to make your point. Um, I'll make a slightly different point, but it gets to the same place. The fundamentals are one thing, the business is one thing, stock price is something else. The stock is not the company is not the stock. Don't forget that. So you can have a company where the stock is overvalued. You buy the stock, company does well, you lose money. Not because it went wrong, but because it's already in the price. It'd be kind of like, imagine you buy a lottery ticket. Jack, I don't think you buy lottery tickets, but imagine you buy a lottery ticket and, you want to play the Powerball. I don't know. I don't even know what a Powerball is, whatever. So you buy the lottery ticket and you got a 1 in a million chance of winning. So, okay. So you buy the ticket, you spend $1, you got a 1 in a million chance of winning. But what if it turns out that instead of selling 1 million tickets, they sold 10 million tickets? So you paid $1, you were told you had a 1 in a million chance of winning. Because the reality was you only had a 1 in 10 million chance of winning. So you do that 1 million times, you're not going to win once. You'll win 1/10 of once. You'd have to do it 10 million times to get paid, not 1 million times. So you're overpaying. You're overpaying for the investment. Conversely, staying with lottery ticket example, say you're told it's 1 in a million chance, but they only sell 100,000 tickets. So if you play 1 million times, you would have won 10 times. This is what investing is about. It's a relationship of the price of admission, which is the price you pay, versus what you're getting. And so everything that Thomas you just said here and nobody you just said here, completely right. You don't have to be, and this is what the people don't understand. You don't have to be bearish on AI to be bearish on these stocks. Walter Deemer, the great chartist, likes to tell the story. McDonald's was a great growth stock in the 60s and the guy in the 70s, and people were loving it. They're loving it, the commercials say. They're loving it. And and what's the problem with McDonald's? But despite all the bullish proclamations, stock can have its own way. And throughout the 70s, McDonald's went nowhere. I think certainly in nominal terms, if not real. I have the chart in front of me. Sure, I'm wrong, but just work with me. It's more the point I'm trying to make. So, despite the fact it was all built up at McDonald's, stock did not perform particularly well during the 70s. It wasn't because the business was bad. Business was good. They opened up all the stores they said they would. And I suspect if you go back and you look at what the consensus earnings expectations were, they more than delivered. It was all good.
George,
Stock was,
it seems like NVIDIA benefited from sort of an ecosystem desire to say, people
yeah,
said, "Hey, I want to invest in AI. Where the hell am I
right,
going to put it?" And they're like, "Well,
yep,
put it in NVIDIA." And then what ends up happening is their stock valuation is priced for perfection. So
yep,
even if they have a great earnings in that, by all accounts, their earnings report this week was beat expectations. It couldn't have been better. People are like, "Yeah, this investment's probably gonna I mean, there's no more headroom in this one." So, just like they're benefiting not from their own operations, they're benefiting from the desire to invest in AI. And what's entered into the ecosystem is a realization that whatever the number is, $2 trillion of data center build out is not sustainable, and the air is going to come out of that investment thesis and maybe going in a different direction. Might happen to think it will go in a different direction. It'll be much less capital intensive. Uh, there'll be lots of losers, and the winners are less obvious to me.
well said, well said. By the way, this is for Thomas and for nobody. I don't have the numbers in front of me, but I've done this exercise a few times. So I've lost track of the earnings. When you guys answer the question, you'll put in the numbers. So I've lost track of the multiple on Nvidia, mainly because I don't care. Um, what's been more interesting to me has been the profit margins. So people say, "Gee, Nvidia, it's growing like a weed. It's only on 30 times earnings, whatever the number is." And I'm like, "Yeah, it's on 30 times that estimate." But I look at how much the gross margins have skyrocketed the last few years. Seem to recall they're up at like 75% now or something like that, and their net margins are obscenely high. And I'm like, it's rare in the history of the world you ever get a company, you can ever see a company that can sustain that type of profitability. So my view is, you know, if you just the valuation, the bubble is not on the valuation of Nvidia. It's not on the PE. The bubble is in the profit margins of Nvidia. And these are not sustainable margins. And the bubbles also, and we can even get into whether the bubbles and the fact that revenues are so far above trend is going to mean revert. But if we just take the first point, Jack or Thomas, you look at where Nvidia's margins are versus where they used to be, and looking out over anything but the short term where they're likely to go, how do you think about the profitability of Nvidia? For either a question for either of you.
Thomas, you want to have a first go at that?
Let me offer a philosophical point on their future. The technology that NVIDIA chips are enabling is going to eat the company that made the technology. And what I mean by that is the chip design and the chip layout and the architecture of how NVIDIA chips are used in the AI world is going to create AI systems that are going to self-optimize and re-architect and potentially undermine the NVIDIA business that enabled it in the first place. So it's like NVIDIA is enabling with the technology potentially, and I'm not saying for sure. I'm saying potentially it's enabling the technology to undermine its long-term business prospects. And if we have, if in these margins, like again, uh, they're going to start to have problems because if you data center build out doesn't match the chip build out, you're going to have chips that are sitting idle that are having rapid obsolescence on the shelf if they can't be deployed. People are going to start backing off their orders. So again, I just think it's I think Nvidia is too frothy here. I like it's a great company. I just think it's too the valuation's too high.
Jack?
I agree with everything Thomas just said. And I mean, look, NVIDIA's margins did improve slightly sequentially in the last quarter. So, whatever margin compression is coming, it hasn't happened yet. That being said, just anecdotally, a couple of stories to keep an eye on. You've got Google's TPUs are coming. Google has made a lot of deals. They're selling a lot of chips now. You had AMD's tie up with OpenAI this week, where AMD's, or OpenAI is going to come out owning a big chunk of AMD. They're going to use a lot of AMD chips. You had Amazon is funding. They're the biggest share of the funding, the most cap raise that OpenAI has done. And that involves OpenAI buying billions of dollars worth of Amazon's chips. So you can see the competition heating up. That's going to lead to margin compression, space becoming heavily commoditized, like I said earlier. So I don't think it's reasonable to expect these 73, 75% margins NVIDIA's enjoying now to persist.
Hey, Jack, just 1 second. Yeah, agree. Everything. Great point. Same thing, Thomas. Jack, you messaged me. Coleman's going to get here soon.
Yeah. I texted Bob and he said he'd be here.
Hey, Mullin, I'm talking to you. That's marathon resource advisors. Everyone should look at him. He's in the third row on the left. He's probably drinking coffee because it's early out in the Bay Area. But anyway, Bob, if you could jump up on stage for a second, I want to talk tankers with you. Heyo, Bob, how you doing, man?
Oh,
Can you hear? There
I'm
you
good,
go.
George. How you doing
Excellent,
today?
excellent. Thanks for popping up on short notice. So, for those of you who don't know, Robert, he can't say this. He's bound by SEC rules. But he was up triple digits last year. It's obscene how much he's up this year. Storied career. Franklin Templeton runs his own money. Smart guy. Lit up the room last summer at our conference. I got to do the pitch right now. Give me 30 seconds for the used car salesman routine, then I want you to talk about the tankers. So, Robert showed up last summer, had a great idea. He's graciously going to be addressing the summit. It's March 11th. By the way, guys, I've been overwhelmed by the response. We cut the price on this to $99. You got Robert and 14 other sharp guys. Nobody special is going to be there too. So you got 2 of the 15 speakers, 20 minutes, no bullshit, 6, 7 hours, stock ideas. You're going to come away with, some good ideas. No fireside chat. We're not going to ask nobody what it was like growing up in New Jersey because nobody cares. We just want his ideas. And so 7 hours, $99. It's kind of like good old stock idea dinners I used to go to back in the day when I was at Fidelity, and guys show up with ideas, and it'd be great. 2, 3 hours later, you come away with a whole bunch of ideas, and the price of admission was an idea. So we're trying to recreate that experience for the investing public. $99. I'm not going to make a lot of money off of this. I don't really care. I'm trying to help people. And you look at our lineup; it is a murderer's row of people. I mean, to have a conference, just imagine a conference where Robert's the keynote speaker, or nobody. Don't let this go to your head. Nobody's a keynote speaker, right? That alone would be, would be a draw. I'm giving you access to 15 of these guys. So real quickly, Renaud Soler, a former mate of mine from Fidelity, runs an energy fund out of Europe. Tom Chanos, Jim's brother, he had Fresh Present short idea last summer. It was great. Tom Thornton had DoorDash as a short. It's great. Adam Parker, former head of former domestic equity strategist for Goldman for Morgan Stanley. His pick ATMU was up 40% last year. Gordon Johnson, no stranger to these spaces. I don't know if he's going to talk about Tesla. I hope he does. Even though I'm going to talk about other things, like now's the time I think on the short. Robert Mullin, who's going to hear from in a second. Zach Marks, Enrique Abeta, Alberto Alvarez. Oh my God. He had like 4 or 5 picks. They were all up between 100 and 500% last year. It's just outstanding. Tavi Costa knows the introduction. Van Drunkenmiller is going to sober up for 20 minutes. I don't know if he's going to talk about Diageo or what he's going to talk about, but he promises he'll try to be serious. Don Durrett needs no introduction. Him and Tavi, I mean, the 2 gold guys with the highest visibility. Nobody special. He's going to be doing his thing. And then Jay Pulaski doing the keynote on shifts in global asset allocation, why you got on emerging markets, commodities, all that kind of good stuff. So you're getting all this for $99. It's March 11. It's a week from Wednesday. You can't go out to dinner for $99. You get 15 speakers like this, and the replays will all be available in 24 hours. So what can I say? It's a free country. No one has to subscribe. But from where I sit, This is the best conference ever in the history of the world. And I say that because I have the best speakers anywhere in the history of the world. I will not be presenting, so you all can breathe a sigh of relief. You don't have to listen to me. I will summarize. I will ask annoying questions as I usually do, but I'm not going to be presenting. Again, it's imagine, you wanted to put a concert together, and instead of just taking the local symphony orchestra, you go out and you say, okay, we're going to pull the best musicians from anywhere in the world. That's what this is. So I urge you to all come. Nobody will be there. Marathon will be there. So Robert, could you give us just a few minutes on what's going on with the tankers? I mean, you and I last saw each other last summer. It was August or whenever it was, or maybe September. I don't even remember. And you said tankers. And Dustin Hoffman imitation, you know, from The Graduate, tankers. And like that was kind of like page 16, Don Cox, please call your office type stuff. People weren't focusing on that. It was all, copper, silver, gold, all that stuff. So give me the update on the tanker trade. It's really printed since you mentioned it. But where do you think we are with tankers? Where do you think this plays out? Should people be looking at tankers and which names? Robert, the floor is yours.
Thanks, George, and really excited for the conference coming up here relatively soon. So I will tell you my thesis on the tankers going back, look, a year and a half ago, where there are some things that are idiosyncratic to the group. There were things that were attractive to me as someone who's inherently, typically, at least modestly long traditional energy securities, where there were things that being long tankers helped insulate you from. So I'll walk you through those super quickly. The first was uh, direct to the tanker markets. What we had seen is both because of the depletion of number of shipyards globally, as well as the really high margins for things like LNG tankers and container ships coming out of COVID. Most of the remaining global shipyard capacity had been tied up with those two things, and they weren't making a lot of tankers anymore. So if you take your VLCCs, that's call it 1,000 boats. They typically last 20-ish years, so you should be replacing 50 boats a year, give or take. We were, taking new deliveries of 3 to 5 VLCCs for the last 3 to 5 years. Maybe one year where we had 10 or so. What you had is you had a lack of retirements, and the lack of retirements was you had all these 20, 23, 24, 25-year-old boats that really should have been retired and scrapped, but they were operating in what we call the shadow fleet, which is effectively when you've got people who are sanctioned like Iran and like Russia. You need people who are willing to operate in the shadows to move those barrels around, typically to China and to India, et cetera. And so you have these crappy old boats that should have been scrapped, operating at very high rates, taking all these volumes around the world, and that's taking market share away from what we call the registered fleet, the good tankers. So that was one dynamic, which was, at some point, the operating environment on these sanctions was we were calling sanctions, but we weren't enforcing them. So either way that you moved, if you either decided to actually enforce the sanctions and start boarding these boats and taking them out of supply and making them really expensive to run for the people who are taking the risks to run them, that would be great. You get them out of the supply demand market. It's about 10% of the fleet. So in a business like this, when you go from 85% utilization to 95% utilization, the difference is really big. You're talking about going from 40 or $50,000 a day to 150 to $200,000 a day. So that was one facet of it. If for some reason we all got together and sang Kumbaya and everyone was okay, then you would stop sanctioning the additional boats, and then they would become uneconomic to run because they couldn't charge premium rates. So that was the dynamic that I thought was very favorable going in. There was a secondary dynamic, which was, look, if I'm naturally long oil and gas producing stocks, one of my vulnerabilities going into 2025 was, what if OPEC increases production, whether it's because Trump wants them to, or whether they just are tired of letting the West get market share? Doesn't matter the reason, but that was a vulnerability that I and most people should recognize was something that was dangerous if you're long your typical oil and gas producer. So there was a dynamic here where you could kind of hedge along with along. And that worked fairly well. So you had both of those dynamics working well in your favor. The real catalyst before the war broke out was that you've got a South Korean shipyard or South Korea, effectively kind of a tanker group called Sinacor, who I think recognized some of these very same dynamics and decided to go out and effectively lease up 30% of the incremental available tanker capacity over the last 6 to 8 weeks. I don't think they knew that the war was coming, but I think they saw these other dynamics of something had to give with the shadow fleet, which would effectively make utilization go from the mid 80s to the mid to high 90s. And if that's the case, the day rate explosion would be huge. And the fact that they had cornered all these boats, it's kind of a Hunt Brothers version in the tanker market where they've got the capacity and they can charge what they want and they can keep some of that capacity off the market. So that's what we've got right now. Look, there's a lot of variabilities here. And I think tanker stocks are going to start if they're already started to trade like silver stocks. The difference is these things generate huge amounts of cash flow, and you're going to see the Q1 and Q2 dividends on these things go absolutely bananas. So I'm long two different VLCC companies. That's been our position for the last few years. I've traded some of the product tankers around the edges. They are probably on the margin, definitely beneficiaries here as well. But this is adults only in the pool kind of geopolitical backdrop. So I'll take a breath there and let me know if you want me to do anything else.
Yeah, yeah, Robert, that's fantastic. Very good succinct summary of what's going down. So respectful of you manage money, and I don't like I give. I'm doing picks in my Substack, which is fine because I don't manage money. But I always caveat do your own research. So I'm not going to ask you what stocks. You want to volunteer a stock? That's fine. But I'll ask you questions slightly differently. It's just the way you and I would interview a management team. So if I were to go and just look at, the leading tanker stocks, the leading product tanker stocks, the front lines and ISWs and, Scorpios of the world, right at the usual suspects, right?
Hmm.
We don't have to get clever with some Jack Gamble, Cyprus listed, Norwegian cross listing, blah blah blah, which is only on 2 times EBITDA. No, if you, what I ask you is the leadership. I mean, I'm sure. Listen, everyone likes Keener, however you pronounce it, or this one or that one. Fine, but if one were to just look at the mainstream, say the top 5 tanker and product tanker companies, do you think those stocks will do well over the course of the rest of the year?
I do. And I would actually look to the leaders who are more VLCCs than product, even though they have both done well.
Yeah.
VLCCs have definitely led. I think that's going to be, where the real heat comes in here. But I think, again, the product tankers will do well. You're effectively going to have to, kind of cross over on these things, and we'll run, multiple smaller boats to do the same thing as some of the
Hey,
single bigger boats.
by the way, I haven't had a chance to look it up, but um, has Bugby been pumping his stuff lately?
So it's interesting. Bugby's call option purchases have been quiet for a period of time. So,
Really?
yeah. So at least what I've been able to see. So, but I think I think he got stung a little bit. No pun intended. Last year, and has been a little bit less aggressive in flinging
Yeah,
his
because
PA around.
he begged, he embarrassed himself. Remember, like a year or 2 years ago, he was pumping all his call option purchases.
Yeah.
That didn't quite work out, did it?
I think he met Mr. Theta on those, or at least some of them.
Uh-huh.
Yeah. So there are periods of time where he's been really good. I just haven't noted anything recently where he's very quickly turned a few $1,000,000 into 10 to 15, which he has done in the past.
Yeah, no, look, we all get it right. I got you wrong. And then last thing, I mean, I'm not. If someone wants to ask you a question on a specific name, that's fine. But I know not to do that. I'll ask you a general question, and that is, in the world you're looking at, do we want to focus more on the guy? 2 questions. Do we want to focus more on the guys who got spot exposure, or do you think it doesn't even have to be that? We could get into a situation where increasingly you're going to see tenders going out for longer, moving away from uh, spot to contracted rates because people realize we're in a different environment now.
Yeah. So what I think you've seen from the smart guys is they're doing a little bit of longer time charters. So, going out 9 months to a year, you saw that rate structure move up over $100,000 a day. Basically some kind of about a week and a half ago. That's going to go higher here. And so I think you want smart management teams who are going to sort of methodically leg into some of those longer term contracts, because in all likelihood, we're not in a $100,000+ a day rate environment for the next year or two. These things are volatile, and we know that things, there could be a resolution very
Right.
quickly. I'm with you in that. I hope that's the case in terms of what's
Right.
going on in the Middle East. But I think most of what you're going to want to get here is spot. That said, the market tends to trade things without really doing the work that you and I would do to figure out
Yeah.
who's got spot and who's got term on. So I think these are trades. Tankers are always trades.
Great.
Treat them as such, stay liquid, and keep your head on a swivel.
And so, if I heard you correctly, what I don't want to do is buy a company that's got everything termed out at 5-year contracts right now, correct?
Yeah, even though the stock probably will go up, you won't see the income/dividend convexity that you would hope to see, or that you will definitely see from some of these other guys. So, when these guys start throwing out, their Q1 dividends and start guiding Q2 dividends, the numbers are going to be, just wildly, wildly big. And so and those will be the guys who can talk more about that, are the guys who are on spot currently.
Yeah. So stay on stage, but Robert, this has been fantastic. By the way, Robert runs money, private money. He can't say very much. I can say stuff he can't say. I have no financial relationship with Bob. He's just one of the good guys. Got a really impressive record. If you're looking to put some money, take your stupid money out of SPY and give it to someone who knows what they're doing. He's an alpha generating machine. I teased him, and I think it's only gotten worse. You and I had a conversation like, I don't know, 2 weeks ago by email text. And I'm like, he's up triple digits last year. He can't tell you that, but I know that. And he was up like some obscene number like through the first 6 weeks of this year. And I teased him. I was like, those are like freaking Madoff like returns. He goes, nah. If I was ego, Bob, what'd you say? I prefer to report these numbers over a year rather than 6 weeks or something. I forget exactly what you said. It was ridiculous.
Yeah, it's Madoff didn't gained or deferred attention by being
Yeah,
very small and methodical, and
yeah. So, Rob,
we
what
don't
you
have
really
the
need,
benefits of that.
yeah, Rob, what we really need to do is do you need to do a structured transaction with Goldman Sachs, where you can defer some of your gains and amortize it out over the next 10 months. I think you'd pay up for that type of contract because it would make you look better, no?
Yeah, the world loves smoother returns. We've just never been in that game.
Yeah, exactly. All right. Stay there. Stay there. I want to go. So many. Oh my God. This is like, we are back. I love when people say we're back. We're so back. Between Thomas and nobody and Marathon. And by the way, this is the beauty of X. Even though I hate this platform, this is the beauty of Spaces. Nobody and I plotted this out. We had no idea Thomas was going to show. Bob actually got up early out of bed just to be here. And then we got Coleman, who's somewhere in Idaho. He's now with us because nobody went and found him. So I want to go to Bob. Hey, Bob, are you out there? Earth to Bob,
Yeah, I'm here. We're still alive.
still alive. Are you in Idaho? Where are you?
Just right outside Boise.
How cold is it? What's the weather like there?
It's actually about 50, so it's pretty nice.
Oh, all right, cool. All right. So as you and I know, 48, 72 hours of turning this business. Nobody, you and I, have generally on the right side of this thing for the last month. I got some definite ideas, but I'm gonna let you go first. So give us your up. And again, predictions about the future are dangerous. Predictions are dangerous, especially about the future. AKA, Realty Bear, please call your office. The short term's particularly tenuous, but give us your thoughts, whatever you want to talk about: gold, silver, short term, long term, medium term, Iran. As nobody was talking about, the cooling system blowing up at the Comex again the other day. Whatever you want to talk about, have at it, Bob.
Sure, sure, no, definitely. Yeah, the Iran thing, obviously, there's no sense in talking about that too much until tonight. When the market opens, I've seen so many takes on the market's going to gap up, the market's going to gap down. There's talks, there's no talks, so it becomes almost like just yeah, a brain drain. But last week obviously there was a big issue with for those that aren't aware. I think it was Wednesday, if I'm not mistaken, the going right into the 130 close. Basically, for those that aren't aware, the old futures pits used to have a close at 130 New York time, and that's really where a lot of funds price and so forth. Well, you had the CME didn't say anything or hasn't said anything yet from what I've read, but basically the futures markets in natural gas, energy complex, and precious metals all went down about 20 minutes before that closing period, and they stayed closed through the closing of that 130 time frame, which caused a lot of problems in the spot market world because a lot of wholesalers use the futures markets to hedge with, and so everybody just shut down when the COMEX basically or the CME stopped trading, and that and that just kind of shows the fallacy of the system. But and then of course the market fell $4. I think after everything opened up, it traded kind of flat, and then all of a sudden just took a nosedive. So a lot of people are there's. It's one of these things where you try to follow the money. I'm not a big conspiracy guy, but you know there could have been someone that was obviously cut short and needed to try and settle, and obviously couldn't settle into that 130 close. Otherwise, we've never seen the CME lose the system during the trading day. I mean, for one thing, if it's 2 in the morning, that's one thing, but during the trading day, right at a major closing time, is a totally different issue. But to give you a little bit of an update in the futures markets, one thing that I'm kind of seeing here is the open interest on silver, for example, continues to nosedive. You haven't had, a lot of people were calling for, the COMEX to blow up with the March roll to May, and of course that never happened. That actually was fairly smooth, rolling the contracts out, closing their short positions in the March contract and rolling to the May contract. But what you're seeing though is which is concerning is the amount of open interest that's basically just dying. I mean, we were at 161,000 contracts of open interest about a month ago, and I think it's down to less than 120 or 117,000. Um, People and it could be due to the increasing margin rates. It could be due to liquidity and volatility. People are taking less sized positions. But you're seeing, what I'm hearing from the wholesale community is if you're trying to hedge a good sized trade on the futures markets, you're not getting very good price fills. Meaning, you come in and sell 15 lots of silver, you're going to get multiple different prices because you just don't have depth anymore. And so a lot of these guys are starting to move to the OTC market, where the banks are now. Like J.P. Morgan and so forth are making are providing that hedging all in one price, and so that's a little bit concerning because that's going to create more volatility with less depth in the market, meaning prices can get pushed around so much easier. That's one thing, and then of course in our industry, in the metals industry, bars and coins and so forth, you continue to see massive spreads amongst online dealers out there. You have a lot of jockeying around on the bids and offers, and I think it's it's going to create a lot of frustration for the consumer and for the physical metal investor that's trying to take a position. He's being forced to basically pay up for a lot of different products out there. I mean, I'm seeing $20 to $25 spreads. But when we were in the 80s or even in the 70s, you were looking at 30% spreads between bid and offers amongst most
Hey, Bob.
primary.
Hey, Bob. Bob, 1 second. I have to step away for 60 seconds. Bitcoin Tina, can you please moderate if anything comes up for the next minute or two? I just have to step away for a second.
Absolutely,
Okay.
George.
I,
Absolutely.
I don't want to move rooms because of my phone because sometimes the reception blows up. So I got to go in the other room for 2 minutes. Keep talking, Bob. Go ahead. Keep going.
Sure, sure. Well, what's happening in the physical world is you're seeing a lot of sort of I don't say profiteering, but there's just a lot of garbage out there, which is creating a lot of fear and hype, that is causing a lot of the dealers out there to basically, they're allowing them to really widen spreads where you're paying, $15 over spot for certain products and paying $6 to $8 under spot for that same product, and I don't know why the industry is doing this, basically because it's unregulated. But what it's happening, I think, is you're seeing demand really drop off very quickly amongst precious metals investors, and it's a shame because obviously with the market moving back up here, and obviously with these world events, there is a need for physical metal, in terms of from a long term perspective. But that gives maybe a little bit of summary of what's kind of happening.
If I could, Bob, I have a question for you.
Sure.
Over last summer and earlier last year, we saw a situation developing with the refiners that they were just backed up by all the retail selling, which was, the opposite of what you described, where we had premiums were compressed to lows I've never seen before. It was great while it lasted. Have you seen any change in that situation? Like I'm seeing 90% junk is still really cheap. You can still get it under spot. I'm guessing that means you can't sell it also. I mean, has that moved at all?
Yeah, no, it's improved maybe just slightly. Uh, one of the things with some of the tightness and some of the sovereign coin market, you have seen some people go to the junk silver market, but the sad part about this is on the wholesale market right now. I mean, you're still selling. If you're selling junk silver, you're still only going to get maybe $12 under spot, something like that. Whereas we're selling to clients at like $5 under spot. And the sad part is all these big online guys, online dealers that boast billions of dollars of transactions are trying to tell you we got junk silver at spot, which is pretty bad because I'm selling it for $5 under spot, and that's not a special. That's every day. I could do that all day long. But it's a problem with the industry sort of providing a lot of misleading information about true accurate pricing because people are buying this stuff thinking they're getting a good deal, and then when they go to try to sell it, it's basically a slap in the face. When they see the bids that they're getting, that's the difficult thing that I think is creating some of this anxiety amongst physical buyers. I see it a lot. I hear it from people. I hear it from people that have called the last 3 or 4 weeks saying, "Hey, listen, my dealer that I've had a long-term relationship with isn't wanting to buy back the stuff, or if they are buying it back, it's like, the bids are horrible, or they can't pay me for 4 weeks. What can you do?" So you're seeing, this is ultimately it's affecting, I think, so- unfortunately affecting sort of the long-term viability of this industry.
Does anybody else have more questions for Bob?
I was going to give somebody else a chance, but I have another one, so I'll pig out. Um, Bob, we saw the big sell off that we had at the end of January, and then we had a nice dead cat bounce, and then gold has since taken out the high of that dead cat bounce on February 4th. Silver started to challenge that level, which is right around the time we had that cooling issue or whatever the technical glitch was this time. Rejected that level when trading came back. We have since broken out from that. I mean, am I reading too much into that February 4th high right now? What do the technicals look like for metals for you right?
Yeah, you got this rising wedge. I think that, like you just mentioned, gold broke through its rising wedge last week. Silver was attacking that, I think, at 90, 91, 92, or 91 and a half, I think, is where it had that that bounce after that big sell off, and then bounced back up, and then came back down. But yeah, it's going through that rising wedge as well. I think if you look at platinum, I think that a lot of these metals are trying to regain some of that momentum. And with miners breaking out to new highs, it's attracting, money attracts money, and I think that's one of the positives of the commodity space right now in general, is there's just still a lot of momentum money coming in, because financials, technology, they've all been in the dumps, and people are looking for, they're rotating and allocating capital, to sectors that are working right now, not necessarily trying to find, trying to stay with, maybe the long term focus on financials, thinking, okay, interest rates are going to come down. That should maybe be good for banks and so forth, or other types of financials. You're seeing some real destruction, and it's forcing money to move into some of these, like energies and physical commodity spaces. So that's a positive, and I think it's showing up, like you just mentioned, in the charts, where you're starting to break through these rising wedges, and you're rebuilding. Like I mentioned, I posted a chart on natural gas a couple weeks ago, showing natural gas in 2022, when it went up two or three fold, then dropped 50% in a very quick period of time, and then rallied back within a month and a half to make, a new high. And I kind of compared that to, listen, if silver is going to do the same thing. This is one example of how it could do it. And so far, silver is starting. It's obviously been overcoming from $70 an ounce, a couple weeks ago. It's trying to gain its traction back, and build that momentum. And obviously, with the problem is these news events like Iran and so forth can become, this gap, where the where basically the market moved from like 110 or 105 straight down to 80 in a very quick fashion. That so-called, big drop or void, the market's trying to fill that void back up, where there was not a lot of volume, uh, from that drop from 105 to 80. It was just basically a beeline down, and so the market's trying to regain that, and fill that void. And that's a good sign, initially.
Hey, so I'm back. So I don't know if you covered this. I caught the tail of what you said, but Jack, did you ask Bob? Jack, hold on. Let me start over again. Calm down, George. So Bob, I was discussing with Jack the other day. There was a story was pointed out to me a few years back, analogous, I think, in the nickel market to what's going on with silver right now, and specifically, you're aware, and you could explain to us, there was this elephant that came in that was really loud a couple weeks ago. He had the crackdown on silver, rallied back up, and then it did like a $15 day a couple days later. And there was this one really big sloppy seller, Chinese time, that killed it, and he wanted to be known, et cetera, et cetera. So it instills fear in the market. Price continues to dribble down. It'll show itself where the bottom is. Maybe it's already shown itself. We've seen the bottom. But the point was, in 22, there was a situation where similarly in nickel, some guy came in, slammed the nickel market, did it deliberately, was loud. Because you go down for a bit more, but once it bottomed, it's a perfect setup for the long, because the market now knows then that he's long, he's trapped, and the price of nickel then tripled. So, can you please explain? Is this all hype, or is it actually the case that there is this whale who's short, and is that true? Is it not true? And if it is true, isn't that a healthy thing for the price?
Yeah, no, you're absolutely right. There was a story that broke, I think, right after the big drop on January 30th. I think it was the following week, where this Chinese, trader, billionaire guy, that I don't know if he owned a clearing firm, but was short, 450 tons of silver. And to give you some perspective, the Shanghai Futures Exchange right now only has about 350 tons of silver back in the entire exchange.
Wait,
Um,
wait, 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 wait. Say that again. Say that again. I thought I misheard you, but I didn't. I'm teasing you. Say that again.
Yeah, he was short 450 tons. I don't know. There hasn't been any more word from him, through their news agency and so forth. And the regulators have been cracking down and closing accounts, And that could have been one of the reasons why the market lifted back higher. But the Shanghai Futures Exchange on silver only has 350 tons of inventory. So and I believe he's short like a June contract. So he's not in the front month delivery time frame, but still, like you just mentioned, you're short that much metal. And it was word that he was trying to play the spread between London and Shanghai, so he could have been long in London and could have been short in Shanghai. But you don't play with that much metal trying to take advantage of an arbitrage situation in two different regions, and especially with the settlement structure is so much different between London and Shanghai. With that said, you're right. There was a trader in, actually, I believe it was another Asian investor or owner of a resource company, and he was short nickel. He was I believe it was maybe a processor, but was short nickel, and then just got blown up. And it turned out that the London Metals Exchange (LME) canceled a lot of trades above, I think it was 70,000 or $60,000 a ton. So they screwed a lot of longs over. It turned out that the LME is actually owned by the Hang Seng Stock Exchange. Yeah, and you couldn't make this stuff up. And basically, they bailed the guy out. Well, this situation, it could be very similar, like you said, just from a market structure perspective, that the guy can't get out. And then the market's going to realize, okay, this big move down was really forced selling. It wasn't really fundamental. And all of a sudden, people are going to start buying again. And that's why what's interesting with when I mentioned the COMEX earlier, with the lack of open interest that's taking place here, and also people have to realize the registered inventories have dropped over 100 million ounces since October. You're seeing less and less liquidity at the COMEX, which
Wait,
is
wait, Bob. So what's happening? Guys are just saying we want we're taking delivery. We want the metal. Like, why is the open interest going down so much?
that's one of the reasons. It could be due to the CME constantly raising margin rates to quell volatility. That was one of the reasons. Also, you have to remember the CME or the COMEX being in New York. There was the EFP or exchange for physical premium, basically the differential between London and New York was very favorable to get the London to metal, or get the metal to London. So you had lease rates, and you had backwardation and so forth. So it didn't make sense to hold the metal in New York because the demand was really in London, and that was due potentially to the ETF market, which stores a lot of their metal in London. And there's a lot of physical activity that goes through London. So what's been happening is that you've had 100 million ounces of registered metal flowing out of the COMEX and into potentially London or India, wherever it may be, but the metal is going where it's best treated. And that's actually a good sign because it's telling you the market's functioning. You just have players that are arbing and making money moving that metal from one location to another. It doesn't mean it's the end of the market's going to blow up, that type of thing. It just means metals flowing properly. Now the real question is, does the U.S. market heat back up at all, where that metal then is maybe starting to maybe become more demanded back here in the United States? But that would be interesting because you don't have the liquidity. If people started to try to go to the COMEX and start taking delivery, um, uh, you don't have, when you're buying long contracts and so forth, if you don't have a lot of shorts in the market, and obviously you don't have a lot of longs either right now, um, y- uh, a wave of money coming in could pressure that market to one side or the other. So meaning, if the market's going back up and you don't, and all the longs got liquidated, and you're short the silver, for example, and you're trying to close out the contract, all of a sudden you have less and less people that are going to sell to you. There's less longs in the market because they all got liquidated. So that causes the shorts to basically get squeezed right back up. And I think that's what is happening. And that's one of the reasons why I posted that natural gas chart a couple weeks ago, because that could have been the same type of scenario where you had the longs get completely liquidated, and all of a sudden there's no liquidity for the shorts to get out.
Oh boy. Oh boy. Jack, you liking the sound of this?
I do like the sound of this, and I have a question for Bob. And
Yep.
Bob, try to be aware of my own biases and try to keep myself in check. And admittedly, I'm very biased in a negative way towards information coming out of China. A lot of people that I follow, that I respect, and I agree with on most things, send me a lot of links, a lot of happenings in China. And over the last 3 weeks or so, I have seen this big arbitrage has developed between the Shanghai Gold Exchange and the Shanghai Futures Exchange, where silver, the same metal in the same city at the same time, is trading at a $5 difference between these two exchanges. And I look at that and I say, why aren't guys buying metal and walking across the street and making $5 an ounce on it? And it makes me just want to tune out everything that's happening in China because it just doesn't pass the sniff test. It strikes me as these are not serious people and this is not a real metals exchange. And so I shouldn't take any signals from it. And I'm looking for somebody to tell me why I'm wrong about that because I know I'm very biased towards this Chinese information. Like, how could you possibly have a $5 difference in the same city between two different exchanges?
Yeah, I don't follow the market that close for that. I mean, you have to remember one's a spot market, one's a futures market. So you could get into a situation where, if the guy that's short all this metal on the futures market now is trying to cover, he could effectively create a massive premium on the futures markets, and also at the same time, you had that silver ETF in China that basically, I think it was the only silver publicly traded ETF that basically was just buying silver futures. They weren't buying physical metal, and that fund, as we remember back at the end of January before they got shut down, was trading at a 30% premium to NAV, and on top of that, the futures market was trading at a $13 premium above the New York market. I mean, we're talking nosebleed on top of nosebleed. And so you could be seeing the similar effect of the spot market over there. Basically the futures market's in a wild contango at the moment, and that contango could be due to somebody that's short that's trying to get out, or I'm not too aware of the value added tax rates and that type of thing. Dealing with taking delivery out of the futures markets versus the Shanghai Gold Exchange. That could be another reason too.
Is there an efficient mechanism to close that arbitrage gap like we have between New York and London where the metal starts to move and go where it's treated best?
Yeah, it between New York and London, you saw this at the end of 2024. Or the tariff thing got everybody worked up. All of a sudden, metal was flowing into New York because you went into a massive contango, beating the lead month futures contract was accelerating higher vis-a-vis against the spot market, and so people were taking advantage of it. You basically could make $1.50 arb, for example, per ounce. So it paid you to put that metal on a ship, for example, or on a plane from London and ship it to New York and sell it there and lock in your arbitrage gain. And vice versa, when the tariff kind of settled down and all of a sudden, we went into a very big backwardation in October of last year, where you had lease rates really high in London. You had extreme tightness over in London. So basically, the cost of metal got really expensive in London versus New York, because at one point you were at a $3 backwardation in the futures price compared to the London spot price, and that's huge. It paid you to start pulling metal out of New York and sending it to London. Now, that's a natural event. There's nothing wrong with that. It doesn't mean, a lot of these guys in the retail metals world and promoter world will tell you, oh my God, the COMEX is going to blow up, LBMA is going to blow up, everyone's going to blow up, everyone's going out of business, the banks are going to fail, and the only ones that are going to be around are the retail gold dealers. Yeah, that didn't happen. What you did have though was the system working, arbitrage taking hold, and then metal just simply moving. And what's happening is, since that metal has moved out of New York, a lot of volume has also left as well, and a lot of open interest has left as well. So that's where this could get interesting if you have a sudden surge of of activity again, and volume at a time where there's not a lot of liquidity or depth in the market.
So I guess I'll repeat the question because you did do a very good job of explaining the flow between New York and London. Do we have anything resembling that flow between New York and London and Shanghai?
Well, the Shanghai market, it settles in Chinese currency. So the question is, do you want to take metal over and sell it in China and hold renminbi, and try and get out of that, vis-a-vis the exchange rates and exchange risk and that type of thing. That's a potential cost factor that could be inhibiting some people trying to take advantage of that arbitrage. Whereas in London and New York, it's a very established market. Banks are making markets all the time. Money flows very, very freely, very quickly. You may not have that same convenience over in Shanghai, and that could be what's causing that stubborn premium.
So Bob, um, again, it's so hard to know exactly any precision, but looking say up. I went out a few days ago and I said that's it. The correction's done. All right, because the way I just watched the way it traded. I don't know all the inside baseball stuff you do, but I just watched the tape and the way it trades, and I'm like, that's it. And even the Bulls were saying, oh, yeah, it'll go up eventually, but we have to go sideways. We have to have the burn off the RSI and the MACD and the blah blah blah. And I said, no. I said, it's done. That's a narrative. Watch the way it trades. And I was focusing on the story about this guy being caught short. So I'm like, that's it. We're done. I kind of went out on a limb, said, we're done. We're going back up again. And nothing goes in a straight line. But I'm of the opinion that gold and silver over the course of this year are going much higher. I don't want to make a forecast for next week. I don't want to make a forecast 5 years from now. I'm talking about relevant time frame, being an investor, the next 10 months, say D's 31. All right. So we can play a little game. You can either say to me, yeah, it's going higher, it's not going higher. Or I could say to you, try to contextualize your bullishness. I'm not going to hold it to you. But if we're in Vegas, Bob, and we do the over under, right? And I say to you, gold, what's the over under? Like for this year, one touch. Someone says 6,000. I say I take the over. 7,000, take the over. 8,000, I don't know, whatever. I mean, put it this way: if gold only goes up 20% from here, I'll be disappointed. I'm talking this year, and ultimately it might go a lot higher, whatever. But just like I'm really bulled up right now. I could be wrong, but I'm really bulled up. And he said to me on silver, I'm talking paper silver. Yeah, we're going to new highs. Can we do $1.50? Yeah. Can we go a lot higher? Yeah. I just think it's going up a lot more and a lot sooner than people think. So, how would you answer any of those questions?
Yeah, I think based on that one natural gas chart I published, yeah, it could go right back up. The scary part, though, George, is that I think the worst thing for the physical industry would be this thing goes screaming back up, like for silver, for example, goes back up to 120 or surpasses that in a very quick time frame. And I think the selling is going to be enormous. I think a lot of people that missed the 120 last time are going to say, I'm not going to double, I'm not going to watch this thing drop another $50 on me. And I think the retail is not going to believe the rally, and they're going to be sellers into this, and that could cause a lot of liquidity problems for this industry.
I love, I have to chuckle. You forgot more about silver than I'll ever know. I want to trigger nobody. So Bob, what you're telling me is, let me get this straight here. So basically, you're telling me the price of the metal is going to go in fuego, and your biggest concern is from 150 or 200, it could do a dirt nap. Is that what you're telling me, Bob?
Well, yeah, it it could pull back hard, but that's not the problem. The problem is for a lot of consumers is getting out. I mean, you may see $180 silver or $200 silver, but the bid may.
Bob. Nobody's gonna have bought bought his own South Pacific island with his future profit, the silver profits, right? Like, well, this is what's known as a high class problem, right? Bob, nobody wants to know, like, is he going to be able to make the down payment on that island he bought? What you just told him is that he will be able to. But then it's like you're presenting the thing completely. Like, yeah, it's going to go to 150 or 200 and then it's going to crash. Is that what you're telling me, Bob?
No,
Basically?
no, no, not that it's going to crash. The problem is, you could, I mean, obviously, the general market could get, later this year, especially going into midterms, you could run into issues with the general market. But the concern is, let's just say we go to 150 on silver. All of a sudden, everyone and their mother starts selling because they saw what happened in
Uh,
January, and
uh,
the problem is in the physical world, not necessarily ETF world, but the physical world. You could start to see liquidity issues really
I
start.
get it. Bob, I get it. Let me ask a question. No, let's question over. Cut to the chase. And Jack, you got to help me with this guy. Like, I'm not being very articulate right now. Bob, what's the probability that paper silver is going to hit 150 this year in your view?
I think it, if you're looking at from a percentage standpoint, you could probably look at 60% type of 60%.
60%. Wait. 60%, that's all?
Well,
That's all?
it depends on. I mean, you could go to 180. There's Fibonacci numbers that take it up to 180, but 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 the the issue that I'm seeing though is, yeah, you could get to 160. The problem is, what are you going to get for it when you sell it? I'm talking about the physical bar and coin market now.
Hey, Jack. Hey, Jack, you there, Jack?
I am.
Jack, shh. Don't tell anybody. Question. Because 300 people in the room. Oh, it's a hot mic. Jack. What's this mean for the silver stocks, Jack?
For the silver stackers.
Stocks, the equities, the
Oh,
equities.
okay. Yeah, obviously rocket fuel for miners, right? Fantastic. Good for the ETFs. I think the concerns Bob is raising is the departure between the physical market and the paper market. And when that happens, you get a lot of people tend to get very frustrated with the physical market, which I think is what we saw late last year into the fall. And by the way, that just happened to coincide with this sudden surge of these AI generated a-holes on YouTube running all these fake stories about bank failures and stories out of China. Uh, that is potentially a risk for the industry. I think
Right. But from where we sit, we're just speculators just trying to make some money. This sounds pretty bullish, no?
it's good for a trade. Yeah, absolutely. It's great for a paper trade. There's money to be made there.
Yep.
When the paper market and the physical markets depart from each other, the correction tends
Hmm.
to be violent, and that's what we got at the end of January. And that's why I share Bob's opinion that I like the slow grind up and to the right. I don't like the vertical moves.
Sure.
Well, one thing to mention on the mining stocks, which people may not be aware of, miners will hedge, and it's a very natural course of their business. Part of what takes the market up, though, is when those hedge books start to blow up, and the miners basically they can't fund their hedge book anymore, whether because you saw that in January when margin rates were getting upped every other week, and you were seeing the producers covering shorts and so forth. I think they were being forced out. That was pushing the market higher, and we saw that in 2011, we saw that in 1980, when guys that are short, whether they're miners or producers, whatever it may be, forced out of their position and become forced buyers. That's one issue. The other issue, which I think, which you covered, uh, uh, George, was energy prices. Energy prices are an enormous input for mining companies, and what we've had a very sanguine energy price really for the last couple of years, and these profit margins have been spectacular, no question about it. But if all of a sudden energy goes from the mid 50s or 60 up to 80, that's a totally different input factor of costs that could start to eat away at some of these profit margins. And you have to remember that the miners also are dealing with a struggling resource capacity. They're probably going to have to start buying each other out in order to bring in more resources and so forth, because you have a depleting resource that they're pulling out of the ground.
Jack, we got a situation here. Bob, I'm just like, I'm just blown away by what you're saying.
It's not that miners could keep going higher. There's no question about it. But the money flow will keep pushing that. If the money flow keeps coming in, it's going to keep pushing it higher. The issue though is now you have a varying of other cost factors that weren't maybe an input 6 months ago. Now going forward, if you're right on energy prices continue to move
Yeah,
higher.
Jack. That's true. That's true. But I have one caveat. You're rightfully pointing at hanging in my own petard. However, you got to take all things being equal in normal times, you'd be right. However, I discount what you're saying for the following reason, and that is, yeah, price of oil going up. Yeah, it goes up $10, $20, whatever. The order of magnitude, though, of the price swings we're seeing in the metals is like Magumbo multiples of what we might see in the increase in the cost of energy. So I say you're right. All things being equal, it'd be better if energy prices didn't go up. But the types of swings we're talking about, like you're like, oh shit, silver go up 60% from here. Do I really give a shit if oil goes up 10 or $20? That'd be my response. Bob, Jack, what would you say?
I think that's probably a more pronounced risk for the gold miners, the higher energy prices.
Yeah,
Silver's a little more disconnected from the mining space because most of the silver comes out of the gold mines or comes out of the copper mines. It doesn't come out of dedicated silver mines. We actually have very
right,
few silver mines. So, the silver supply, the new supply hitting the market is more dependent on gold and copper prices than it is on silver prices.
right, right.
That all that being said, just looking at the charts right now and looking at the technicals here, I do think a retest of those late January highs between now and the end of this year, I think is all but certain.
What's that number, Jack? What's that number?
We're looking at about 5,600 for gold and low 120s for silver. I think
Uh,
sometime between now and
okay,
December.
I'll do this right now. I'll bet anybody they want. Okay, all right, right here, right now. Gold's what, 5,200? All right.
Yep.
Okay, and you said the high was 5,600. Okay, anyone wants to DM me, I'll spot you $400. I'll buy anyone and everyone $100. We can even I'll even put a tweet out. I'll spot you $400. I'm gonna do the Larry Lepard, but instead of Bitcoin at 35 grand, betting you it's going to 100. I'm a cheapskate, but I'm gonna bet you that we do 50. We do 5,600. I'll give you. Unless gold goes 5,600, you win. I'm spotting anyone and everyone $400 right here, right now. $100. I'll do it multiple times. And on silver, what was the high on silver, Jack?
About 121, I think, was the high hit.
And where are we now? Where are we now?
We're sitting at 93 and change.
It's 30%. That'd be like I don't want to commit a Lepard mistake. I'm not going to do that. 93. I'll spot anyone. Even money. This is Vegas. 110. I'll give you. Silver has to touch 110, or you win the $100. $100. Any and all takers. Tweet me, DM me. So 110 silver, 5,600 gold, front contract between now and these three. One touch, one touch. Doesn't mean it has to close there. One touch. So any takers? Raise your hand right now. So it's like silent auction. Raise your hand. Come on, guys. I know Coleman's not going to take it. Nobody's not going to take it. But some of my haters, you know what? Let them hate on me. Okay. You know what? You know what? You know what? You know what? We should do even better. I should do a deal. I'll do even better. I'll do even better. I'll do even better. I'll do even better. I'm going to give you guys. We'll do this offline, Jack. You and I got to figure this out. I'm going to give free tickets to upcoming seminars. I'm going to give multiple free tickets. In other words, I'll give you $300 worth of tickets for $100 worth of cash. I got to figure out the terms, though. We're going to have some fun with this one. This is gonna be like stealing candy from a baby because like I am so convicted this shit's gonna go up. It's like, we all make predictions, Jack. Sometimes you're seeing the ball well, sometimes you're not. So it's not just what your prediction is, but like how convicted are you? I'm beyond convicted on this. Beyond convicted on this. Um, so anyway, so someone just messaged me. And well, I'm gonna put a tweet out, so we'll be able to tee this up. All right, Jack, you want to know something? It's your fault. Oh wait, we're gonna answer Tesla 1 second. Jack, this is your fault. You caused me so much trouble. I've lost my voice. I want to tell you something, dude. The magic is back. This room has been exhausting. Exhausting. Between the AI and the shipping and the silver. I mean, does it get any better than this? And we got the real deal here. We got the leading experts anywhere talking on these topics. And people think I'm boastful of shit when I say we got the best spaces. No, we do have the best spaces because we got the best speakers and we got the best audience. All right. Anti-Thetos and then Prometheus, and then we're probably going to end this room. Anti-Thetos, good to see you. What's your question, my friend?
Yeah, hi, George. Hey, thank you, by the way, for introducing me to Bob at Marathon. I did not know of him previously, so he's a new follow for me, so thank you. And that's who my question is to, real quick.
Hey, Mullin, if you're still here, I don't want the referral fee. You got to find some other way to kick back the money to me if you invest with you. All right, go ahead.
All right, so
Fair enough, George. How about a big steak dinner next time I'm in your neck of the woods?
You got it. Go ahead. Keep going.
all right, so I put in the it's not the nest, it's just the replies area. But basically, there was a post that came out. You're obviously familiar. You're tracking this stuff closely. So I was going to ask you the question regarding that tanker called Skylight, and specifically, it appears to be confirmed, right, that actually Iran, was responsible for hitting that tanker, and it turns out that it's an Iranian tanker with a Palau flag, right? And that's from multiple sources confirming. I'm sure you're again well ahead of this before I am. Here's my question: is it possible, right, and that this was actually they said it was because they were defying orders supposedly, but is it possible it was an intentional attack from an economic warfare perspective? And the question I have is, they're saying they're not going to close the Strait of Hormuz, right? So they don't close that, but is it possible that this then starts to impact insurance rates, which also carries, similar, economic, I'm not going to call it sanctions, but problems for these companies in general?
Yeah, it's a very good point. I have been following it. You don't have to physically, and it's virtually impossible to physically close the Straits of Hormuz. It looks small on a map. It's actually a really broad strait. But you can make it highly uneconomic for people to traverse there. So typical insurance rates on a VLCC run like 10 basis points. They're already up to 60 to 70 basis points of a tanker's value. So when you're talking about $100 million piece of machinery, you're going from being able to insure that, for, 20, 30, 40 grand, to, as much as 10 times that, 3, 4, 500 grand, to insure them through a single passage through the straits. So this will slow traffic down if we don't see, a significant deceleration of the aggressiveness here on either side. I would suspect that there aren't going to be many people who are going to be willing to take the insurance risks with, as I said, very expensive pieces of machinery. So, this is you don't have to be physically closed to effectively significantly reduce traffic, and that's going to have some ramifications kind of across all the value chains.
Yeah, one second. Hey, Robert, just short-term question. If peace does break out, because I kind of think sometime not too distant future, whether it's a week from now, 3 weeks from now, 2 days from now, I have no idea. All the experts on the Straits of Hormuz and Iran and blah blah blah. This too shall pass. If this does pass, longer term retractions notwithstanding, if there was a outbreak of peace, would that be a short term negative for the stocks, tanker stocks?
For the tanker stocks, absolutely. Yeah, you're gonna get pirates, gypsies, and tourists in these things over the next week or so if this thing continues to be on, and they will drive them to prices that may end up being unreasonable. I'd say it's a little bit more of a level than a timing.
Right.
in that, if they run these stocks 20 to 50% in the next couple of days, yeah, I would say you're vulnerable to a big, a big repricing at some point.
All right. But if they don't run these stocks, we don't spike. I mean, I haven't looked, and like in the last few weeks, have these stocks gone crazy?
They're up a bunch, and it wasn't necessarily war premium. It was really this, as I mentioned, the Korean company that scooped up a bunch of excess capacity and physically tightened markets.
Right.
So again, these stocks were going well, and business was great. And just give you an idea of day rate structure. So a year ago, a VLCC was charging, $30,000 to $40,000 a day. Your operating costs are 20 grand, so you were making 15,000 to 20,000 bucks a day. Current spot day rates are now over $200,000 a day. That was the case before you had war breakout. This was stuff that was going on Thursday price. So the rates had gone from 150-ish thousand dollars a day higher. So
Sure.
your margins had gone from $15,000 a day to $130,000 a day. So profitability is up 10x.
Right. Right. So okay. So right here, right now, there's not much. There's really nothing built in your view. There's not much built in for war premium right now. Is that fair?
Not in terms of where the stocks were trading at the end of last week. Monday morning, that'll be a different story.
I understand. I
Yeah.
understand. Just people understand where we're because things are moving
Yeah.
quickly. Okay, fine.
Yep.
Because unless you're telling me we're super extended right now because of war premium, which we're not, leaving aside the gyrations from week to week, we all know these stocks have juice. They go all over the place. On anything but a short-term view, like for instance, looking at for the year between now and the end of the year, as I think we asked the questions earlier, as a group, these stocks should do very well.
Yes. I think it's a group that the economic underpinnings of their earnings, and more importantly, when you got a group of stocks that tends to pay out a high proportion of that in dividends,
Yep.
that matters. And so the capital return from these guys is going to be just gigantic over the next 12 months.
And by the way, before we go on to the next question, again, showing for the conference, March 11, a week from Wednesday. Robert, as well as Nobody Special, are going to be bringing their best idea. You're going to ideas from 15 different people, $99. Like, it doesn't get any better than this. Seriously. All right. We now have, I'm going to mess up his name, Prometheus. Oh, he spells it cutesy. Prometheus, what's up? What's up, man? What's up, Prometheus?
Hi, George. Thank you for having me. Yeah, I've just been monitoring the markets. I'm a fintech developer here in the UK. We're coming out with a solution we're calling Earn NFTs. And I've just been looking at oil in the crypto exchanges because they run 24/7. And already with crude, we have IG Weekend, CFD up 10%, Hyperliquid has 5% rise, Ajax, 5% rise. So before the markets open on Monday, on the 24/7 markets, we're already seeing a price hike. So I guess this question is to yourself and anyone else on the marketplace. What do you foresee in terms of the commodities markets being impacted by obviously this rapid geopolitical transformation we're seeing in the Middle East?
All right. So
Yeah,
I would suggest I'm going to have Marathon take the first crack at it and then Jack. Marathon, you want to take that?
Sure. Just if you could rephrase in terms of just kind of
Yes,
specifically what
I
you're
think
looking for.
the general question is, what do you view as the Iranian situation? What do you view as the impact of various commodities on the Iranian situation? I got the
Yeah.
question right.
So, look, clearly this is quickly developing. My initial read on this is very different from the bunker buster kind of quick spike and retrench action of last year. I think the plan here is that Iran's strategy is actually a very logical one, is that they are throwing as many offensive missiles at everybody that they can in the region to deplete the US, Israeli, and other Western stockpiles of defense weapons as quickly as they can. And we don't have months of this stuff. Lots of it, we don't even have weeks of this stuff. That was very clearly evident after the Mishal exchanges that we had last year. So their incentive here, if they're backed up against a wall and they realize that this is an extinction level event for the IRGC and everybody else in Iran, yeah, this is what they're trying to do is deplete as much of the missile defense capabilities as they can. And they're doing a pretty good job so far. This is exactly what you'd want to do. So I think that's my way of circling around to the fact that I think this is going to be a sustained effort for at least for days, if not weeks. And so I think those looking, I bought some oil puts on Friday just in case we had a peaceful outcome. Those are going to go to money heaven because I think there will be an opportunity to try and go after those again, but we're not there. Yeah, I don't think we're going to be there Monday, or probably not for the next couple of weeks. So I think we're looking at a period of heightened geopolitical instability based on higher oil prices, uncertainties in supply chains, and I think risk premiums are going to go up. I think this has the capacity to be very different from the sort of flash in the pans that we've seen from this stuff over the last 4 or 5 years.
So that means increased uncertainty. My view, I share your view on energy and precious metals. I think precious metals definitely going up. I think energy, as I said, you should fade that in my view. I said it earlier because I think it's going to be settled pretty quickly. It's definitely negative for equities, no question.
Yeah,
Nobody thoughts?
yeah. Well, I should one more thing that I'll just add in is that I think
Sure.
there's some nuance here across the different sectors. I think, look, the clearly first read is this going to be good for producers? That probably is fadeable. In terms of service companies, guys who build the infrastructure, you're breaking a bunch of you're breaking a bunch of glass that's going to have to be fixed, and kind of service redundancy is going to be high. You're going to be operating in environments where you're going to get hazard pay a lot. So I think the oil service companies actually are the longer term beneficiaries here. And finally, yeah, my gut is, and I have been short the U.S. refining sector as a group for the last month or so, because I just don't think they're the big beneficiary. There's some really nasty stuff. The refiner sector rallied because they thought we had these huge volumes of Venezuelan crude coming in to the Gulf Coast that would improve margins. We haven't seen the margins improve that much, and quite frankly, the amount of Venezuelan crude that could come in is de minimis compared to the barrels, the kind of medium to heavy sour barrels that we're going to lose for a period of time because of the conflict in the Middle East. That's where we source a bunch of those barrels. So refining margins could get crushed. And I think if if refiners rip on Monday morning, that's where I'd take the other side of that trade.
And again,
Awesome answers. Thank you so much.
Yep.
yeah, that's great. All right, so guys, and
Hey,
again,
George, can I throw something on top of that one?
yeah, please do.
The focus is all on oil, and rightly so, but let's not forget liquefied natural gas. You've got Qatar is the third largest supplier in the world of liquefied natural gas at 77 million tons per annum. And Qatar is being targeted by the Iranians right now, and that gas has to flow through the Strait of Hormuz. So if that is off limits or somehow stressed, then your US and your Australian suppliers are going to capture market share. So names like Cheniere Energy, biggest LNG producer here in the US, would be the beneficiary of that.
Well said. All right, guys, 2 hours and 20 minutes. Jack, this is the problem. It's never short with you. 2 hours and 20 minutes. We gotta stop doing this. My God, this has been awesome, Jack. I can't thank you enough. Seriously, this is great. Really, really good. And Thomas, fantastic stuff. You got to come back. I mean, we are back. We are so back. Thanks to all of you. All right. Stay tuned tonight at 6 o'clock. We'll see what happens. Again, fade the hot takes. Know what you own. If you're buying silver stocks or tanker stocks, it's not because of what it's going to do the next 48, 72 hours. It's because what it's going to do over the course of the year. I'm going to figure out the appropriate wager. I will give people a one touch, 5,600 on gold, 110 on silver, one touch even money. So, yeah, this will be great. All right, Jack. Gotta stop meeting like this. Jack, thank you, sir. Thomas, Bob, Prometheus, everyone. Cantro, you and I is having words tomorrow. We're doing our session tomorrow. I sent you the login instructions for our podcast. All right. The stories write themselves. We'll have plenty more to talk about next weekend. I'll be putting out the bank credit analyst Peter Berezin video today. And please sign up for the conference, $99. All right. Be good, guys. Take care. Thank you. Aloha.
Thank you so much.
Thank you. Bye.